Hello, everybody. Welcome to a new episode of the Boopos Buzz. I'm Juan Ignacio, CEO and founder of Boopos, and we have Ray with us. Ray, do you want to introduce yourself? Comes from bsoft, which is one of the biggest acquirers out there. But I'll let you, you know, discuss your profile and what you guys do.
Sure. And thanks a lot for having me, Juan. It's a pleasure. We've had a chance to meet the Boopos team previously, and it was a great experience. So happy to share a bit about myself and bsoft. Um, bsoft, essentially, we're a software investment firm and acquirer of what we call these vertical market software businesses. So it's always with a very niche focus in specific pockets of the software industry. That's the very high level of a strategy, a vision, and kind of a journey that our two co-founders, Sam and Stefan, started back in 2015-16. Having studied hundreds of quality businesses, acquirers, and long-term technology buyers, always passionate about investing and the metrics and kind of the dynamics of the software world were very attractive to them. So that's how it started back in 2015-16. We made our first acquisition, and that was a successful one. And then each year going forward, kind of ramped up more and more with our acquisitive experience. And today it's a portfolio of over 110 wholly owned vertical market software businesses. So it's been quite a growth journey. Myself, I've been here for about half of that journey. I joined back in 2020, and my background was in engineering originally. And so I worked in that space for a few years, and I moved into the world of finance and the world of M&A. And I was lucky enough to meet one of my close friends, Costa Tagalakis, who's one of our investment partners at bsoft, in school while doing my MBA. And he started telling me about kind of the vision that Sam and Stefan have, and kind of the entrepreneurial spirit that they've brought to the investment world, to the acquisition world. And that just sounded like it was a grand mission, but it was also fun. It was exciting, and it was challenging, and they had a chance to basically shape the future of these businesses for the next 20 to 30 years. And for myself, I didn't really see that kind of opportunity anywhere else. So I decided to join, and yeah, it's been one of the best decisions I've made.
Interesting. Yeah, I'm also part of that engineers in finance mafia, and I think it's a great career choice. It's a very exciting world. So congrats for that. And yeah, you're part of Balsoft, which is obviously a very exciting company. One question that many people ask: what does vertical software really mean? Many people come to us and ask us, "Is my company vertical software, or is it just B2B SaaS? What does that mean?"
Yeah, absolutely. So the basis of a vertical market software is that on a daily basis, it becomes extremely mission critical to that end user, right? Their business can't run without it. Their teams can't function without it. It becomes very, very sticky, and that end customer base is extremely loyal to that product, right? VMS becomes hard to rip out and replace. Typically, the customers have gone through several iterations of the product and several kind of contract renewal cycles. And at the core of it, it's a very, very sticky solution. That's what it comes down to, right? And let's say some of the horizontal players aren't playing in those niches of each vertical. So they typically began as an idea that was very, very tailored to solve a specific problem in an industry, and it's remained that way. So that's what we look for, of course, and let's say the typical subset of vertical market software businesses is in that 3 million top line to 100 million top line range. And that is our kind of appetite and investment profile as well. There are obviously smaller ones and there are more recent ones, but what also tends to happen with these VMS businesses is that, let's say, the majority of the revenues are from that recurring revenue nature. Obviously, that becomes easier to scale. And we are comfortable with those non-recurring components as well in the revenue base. Obviously, there's professional services, there's development, implementation, training, all those things. Those are tougher to scale and tougher for us to kind of push forward. So another kind of metric that is an indicator of these VMS businesses is the churn profile, right? We're looking at very, very high retention, and on a gross dollar churn basis, they're probably under the 10%. That's kind of the, I guess, mathematical or financial way of looking at the businesses. You can look at revenue data from the past few years and kind of put that together pretty easily. But also what we do as part of our process, and that's another indicator that we've seen of these VMS businesses, is we like to speak to the end customers and just kind of understand on a daily basis how critical is this to their operations, and you know how much would they be affected if this stopped working one day or it turned off one day. That's kind of an indicator of that VMS core, really.
Mhm. Makes sense. Actually, you gave me the keys to a follow-up question that I had, or a broader question that I had, which is your investment criteria, what you're looking for, but you gave a pretty comprehensive answer to that as well. Yeah, are there any other particular metrics or key data points that you want to look into? You mentioned obviously low churn, which is an indicator that it's mission critical, but any other metrics that you look into that should be important for business owners to track?
Sure. Yeah. So churn is one of them. I think in terms of the split in the revenue streams, like I mentioned, ideally we're going to have something around 70% or higher, which is of that recurring revenue nature. But really, aside from those kind of quantitative indicators, uh, we like to work with good people and in good management teams, right? Because we have a buy and hold, buy and build profile, and essentially our time horizon is the next 20 to 30 years. We will be married to these management teams, and we like to work with people that share in that kind of entrepreneurial spirit and that have a pathway to grow at Valsoft as we grow, right? We're going to continue to be acquisitive, and there's going to continue to be opportunities for these team members joining to have wider roles, have bigger roles, and have more responsibility ultimately. So when we find those management teams with the good growth mindset, with that long-term kind of vision that we can invest in with them, and the incentives are fully aligned, that's very, very important.
Interesting. By the way, one interesting thing about your business model is that you're acquiring businesses for holding for a very, very long time. And generally, these businesses have been running for a very long time as well before you acquire them. So in a way, the businesses that were not disrupted and won't be disrupted in a very long time, which is quite remarkable for an industry like the software industry, in which there's a lot of novelties all the time. How do you get to the conclusion that there won't be, I don't know, competitors or newer solutions to solve those mission critical elements to this business's customers?
Yeah, I mean, look, a lot of times these software businesses, and then kind of the range that we see them in, they've been constrained with certain aspects, they've been constrained with certain resources, and they're of a size where there's still path for them to grow, right? Even though, like you mentioned, they're typically founder led, and they've typically been around for 15, 20, sometimes 30 years. There are things that we can obviously bring to the table where it frees up a lot of channels and then resources for them. That time horizon that we have in that kind of long-term holding period is what makes us different, and really it gives us an incentive to make the best decision for the businesses to ensure their longevity and continued kind of profitable growth for the business over the long term. One thing is, there's always kind of a lever or kind of a choice in these businesses as to whether they're running profitably or not, right? Based on the life cycle of the business, based on maybe the lifestyle or choices of the owner, founder, whatever it might be, based on targets or ambitions that they have in terms of product and what R&D spend they're doing. So because we're not constrained with that kind of 5-6 year typical PE period, we have flexibility with that as well, right? So the balance of kind of growth and profit, we can assess on a business by business basis as to what's the best choice for this business, and then how can we kind of ensure that long-term profile. I think that's one thing that, in speaking to a lot of founders, owners, sellers, they've appreciated that, in that we have that kind of flexibility as well. So,
Yeah.
like you mentioned, that kind of progress that they've had over however many years, that's not to be disrupted. And if it's working well, then we just want to be able to add to it as well.
And yeah, that takes me to two additional questions that I had on my notes. One of them, and they're somehow related to what you just mentioned. Why would a founder sell to bsoft instead of selling to, first of all, anyone else, or a strategic investor? Maybe that's one competing perhaps option, and then the other one is perhaps selling to another acquirer or a competitor to you. What are your main advantages? And you mentioned a few, but perhaps you want to expand on that.
Sure. So obviously, if you look at our track record now, we have a lot of experience in operating, scaling, growing vertical market software businesses, right? This alone has given us, the ability to put together a set of best practices, lots of resources, and then kind of a peer network that we have around the world now where, for one, being a business leader who has started a VMS business for 15, 20 years now and has been on their own can be kind of a lonely feeling when you're making big decisions and when you're trying to make changes for the business to move forward. So us giving access to that peer network of other operators, other CEOs, and then other leaders in the software space, for them it's a huge kind of unlock, right? Access to all those data points that we've gathered, and we've gone through a lot of iterations of whether it's a pricing strategy, whether it's a bundling strategy, whether it's a technology upgrade, whether different assets of a growing business. We have data points on that, and we've done a lot of things well, we've done a lot of things wrong as well. So we know kind of the pitfalls, and we can guide the management teams, we can provide advice to those CEOs. So I think that's one side of it that they do appreciate, that they can pick up the phone and speak to 100 other CEOs and get their insights. The other one is that they really do care for kind of that future home for their employees and the future relationships for their customers. That matters a lot to the existing founders, owners, and of course, the best valuation matters, but they really do appreciate that kind of permanent home, permanent capital sense that bsoft can bring. And again, we have a lot of good examples of employees that joined through one business and now have a role across bsoft globally or across a portfolio of businesses. And we're obviously in touch with a lot of those exiting founders, and they do appreciate that. So that's kind of a huge addition as well, knowing that, let's say, the culture, history, and then really legacy and name of those businesses will continue to stay on, versus, like you mentioned, maybe a strategic buyer or a PE buyer or some of our competitors that have a shorter time horizon, and you probably have a feeling that business might not exist in 5 to 6 years.
Makes sense. Actually, this is, again, related to a broader question that I had, which is what happens after the acquisition, right? You mentioned that in the end, you're holding these businesses in the long run. You have, I would say, a very interesting database of different companies that you acquired, and there's a benefit for the founder to have that. What other things? And I know that you guys run Valpay, right? Which is sometimes useful for businesses that are processing payments. What kind of founder expect after you close a transaction? What are they expected to do? Should they continue running the business as they are? Will you guys implement synergies? How does that work?
Sure. Yeah. The goal for us is not to run the business on a day-to-day basis, right? And that's why the preference on our side has always been to work with the existing management teams in place. That's been the best formula that we've seen over the years. We like to say we know what we know, and we know what we're good at, but more importantly, we know what we don't know, right? So pretending to be able to replace that expertise and the relationships that they've built in an industry over a dozen years, we're not going to replace that. That's kind of a losing bet. So, and that's worked well with kind of the deal structures that we've had. So we want to be there to kind of support as much as possible, provide the capital resources, provide the human resources, open up sales channels, open up maybe geographic expansion opportunities, open up further M&A within that niche. But really the business is working towards that steady state of operations, right? We're going to have our integration period, that first 3 to 6 months. We have our business transformation teams that will integrate the business into bsoft and everything in terms of reporting. But essentially, things shouldn't change on a daily basis. And there's a reason why we invest in a business, because we think at the core it's a very good business and it's a very good management team, right? So we're not there to disrupt really, but we're going to continue to look to invest in that field, whether it's in that business or it's in adjacent businesses. And the thesis is always, can we become a market leader in this niche, in this vertical? And can we ensure the longevity of this business? Can we weather all potential threats to be 100% certain this business will be thriving in 20 years, right? Whether it's a pandemic, whether it's cyclical trends, whether it's funding for competitors, whether it's technological changes, whatever it might be, we're there to kind of protect the business for the future. Yeah, you mentioned Valpay, for example. This is the internal payment processing division of Valsoft that we started a couple of years ago. And for example, we had a lot of businesses across the hospitality space, the travel space, and the healthcare space that had GMV passing through them. And for us, it was the right play to be able to capture that and do it internally. And as you know, that's a very high margin space as well. So that's one of, let's say, the ancillary revenue options that we're able to add to the business. We have some other projects internally that do that on an ongoing basis. And when we build this out, when we do these projects, we're able to apply that to a wide set of VMS businesses as well.
Interesting. And how do you keep these founders excited about continuing running the business? At least, I mean, from an economic incentives standpoint, I'm guessing that they cashed out and then they're just on a salary, or how does that work so that they have an incentive to continue running the business? Obviously, other than making sure that the business is or that legacy is continuing.
Sure. Yeah. We've done over 100 acquisitions now, probably 110, and there's probably been 110 different structures, right? So there's never kind of a fixed playbook or kind of a fixed formula as to what works best. And that's why, leading up to a deal and leading up to an LOI, we have a lot of conversations with the owners, with the management team, whatever the situation might be, as to what's going to work best, right? And that depends on their timeline. It depends on their appetite to continue. We're quite flexible with this, and that we've dealt with situations where, maybe an owner is ready to retire, move on, and it's on us to kind of find that succession plan internally. We've had good situations where the seller is looking to stay on for another 2, 3, 4 years. And we've been able to structure deals that way where, let's say, within that period, they're getting that maximum upside. There's been many other cases where the owner has continued to stay on indefinitely, right? And so the key there is to kind of align the incentives on both sides. And we know that for them, this is a very big decision, and it's probably something that they're going to do, once in their lives. So we understand kind of the gravity of the situation to provide a structure that, whether it's with milestones, whether it's based on certain growth metrics, whether it's a phantom equity retained in the business, this is going to keep them motivated. This is going to keep them aligned with what we see for the future of the business. And obviously, our structures are evolving every week, every month, as we see more and more, iterations, and as we're maturing and growing as a business. Obviously, without straying away from that disciplined capital allocation, strategy that we have, but we'll have to continue to improve on those structures. And obviously, let's say some strategic players, some PE players are now coming down in terms of the size of businesses that they're looking at. So when we see that type of competition, and in terms of upside for the owners, in terms of deal structures, we're going to continue to evolve in that sense as well.
Makes sense. And actually, yeah, let's talk multiples. You mentioned that there are a few competitors out there that perhaps are offering big checks now, or they come from the PE side of things, and they're going like down to get smaller deals because they don't have that much deal flow in the bigger check world. But I've also seen a lot of roll-up companies starting in this particular niche and trying to acquire vertical software companies. How do you see multiple? I guess that you're mostly focused on the US and Canada. Is that the case, or are you also investing in Europe?
We're all over now. So, it started in the US, and I would say still today, probably 50 to 60% of our businesses are in the US, but we have very strong presence in Europe, and we have very strong presence in Australia and New Zealand as well. So we have a deep portfolio in Europe as well.
And so what are the trends that you're seeing right now in terms of valuation multiples? Are you seeing this competition is driving multiples up, or how do you feel about that?
Yeah, I would say it's a mix, and I would say it's different between the roll-up players versus some of the PE players that are more industry agnostic, I would say. they're still looking at that potential 5 to 6 year timeline return, and that gives them a different kind of edge and a different kind of strategy. For us in the VMS space, it should be kind of a disciplined strategy as to if we're finding good businesses, if we're finding quality teams in niche verticals, we're always going to pay a fair value for it, right? And it's not to kind of compete with some PE players or other types of players, but obviously, as I mentioned, we're going to continue to evolve in that sense and just kind of understanding what the market is demanding at the moment. Kind of the ethos of Valsoft and our two co-founders, Sam and Stefan, is to always have that kind of capital discipline, right? And if we see that it's a very, very competitive process or a very competitive space in general, we're happy to kind of wait for the next one and then make sure that we're making the best use of that shareholder capital. But yeah, they are coming down in the size of the businesses that they're typically looking at. So for us, that's kind of made us take a different approach towards deal structures and be more creative as well.
I guess that the PE firms also have an advantage because they use leverage. Do you guys use leverage? Do you leverage your acquisition?
Yeah. So I would say historically, and the way that Valsoft began its first series of acquisitions, it was always equity financed. But given this move and then given this trend, now we're looking at more levered deals as well. And it's something that we'll do on a case by case basis, on a standalone basis. But it's something that would be necessary for that next stage as well.
Okay, makes sense. But again, so the founder will stay on a business that has been leveraged at acquisition, and I guess that also plays in the profile of returns that he can get going forward, right? Because in the end, having leverage obviously means more return and a little bit more risk at the same time. So is he exposed to that, and is that a decision that you made in consensus with the seller?
I mean, look, these are conversations that we always have with the seller through the diligence period, right? And up to closing, it's something that when we're preparing for the integration and when we're preparing for that kind of handover, we want to make sure that we're obviously as transparent as possible with them, and then to make sure that the strategy is aligned. What we absolutely want to avoid is that, day one post closing, we have different ideas of what should happen. And as you mentioned, if it's a situation where it is levered and it changes kind of the profile of the business, that's something that we want to avoid. So I think the most important thing there is to just have those conversations before that purchase agreement is signed, and just to make sure that we're both kind of heading in the right direction.
It's interesting. I think as we're speaking, I see a lot of advantages in perhaps not being exposed to that PE type of structure. Because in the end, the good thing about PE is that you have this carrot, like you're going to sell in 5 years and you're going to get like another round of cash coming in.
Yeah.
So you're working towards that goal, and that's pretty nice. And actually that's pretty good. But at the same time, it adds a lot of pressure and it might end up leading the business to the wrong decisions at some point in time. So I see kind of pros and cons. So perhaps there's different routes for each of the founders, right? What do you think about that? Is there anything that would make a specific business more suited to PE type of cycles versus more like holding in the long run and permanent capital like you guys do?
Yeah, I mean, look, it's again based on kind of the goals and incentives of the founder or the shareholders or whatever the situation might. Probably the biggest thing would be that importance on the continuity of the business and the continuity of the employees, as I mentioned. That's at risk when you're going that route, of course, but for us, we've always had that kind of long-term approach. And businesses in the vertical market software space, the bulk of them are of that founder-led feeling and of that founder-led philosophy. And from what we've seen, they won't put the entire emphasis on a potential maximum valuation or a maximum kind of deal value, right? And they do care for the future of the business. And then that's why they would come to someone like us instead of looking at that PE route, which, as you mentioned, there's a lot of pressure within that timeline. There's a lot of risk within that timeline, and it doesn't always pan out for kind of a bigger bite of the apple.
That's something that we tell our customers, that in the end, sometimes the highest offer is not the best offer, or not necessarily the best offer.
Exactly. And there was a lot of kind of activity in let's say the 2020, 2021 era within those groups, and then those are coming kind of end of life now. It's created good opportunities for us as well, where we're seeing those kind of quality businesses where there's still a lot of further value to unlock, but let's say the business isn't cramped with issues around financing and reporting and being driven towards very near term results on a quarter over quarter basis. We're not looking at it that way.
Well, those were all my questions, Ray. Do you have any closing remarks? Anything that our audience should know?
I think you guys are a lot more active in Europe, and as I mentioned, we have a very deep folio there, teams based there, and we have a good infrastructure in terms of the resource network that we have there. So it's something that we're always looking to expand in. If your audience has any questions or has any kind of inquiries around acquisitions in general, obviously feel free to reach out.
Amazing. All right. Well, thanks for being here. It was a pleasure. Ray Mohsenin from bsoft. Great having you today.
Thank you very much, Juan. I appreciate it.